Hello, welcome back. We are continuing our series in which we are analyzing all these well-known companies, the massive companies that have fallen off a cliff in terms of their stock price. Nvidia is one of these companies and it could present an interesting opportunity is the thing, and this is why we really need to examine them. And the 1 year high was at 346 bucks. Right now it's sitting at about half that price, down 51.2% it looks like. And we do want to see what's happening with the news on this company, whether there is something new here. It's mostly about talking. It's mostly talking about Nvidia holistically, like what kind of EPS they are making, whether they are gonna be beating and all that. Nothing new really in terms of exciting news here. So let's go back and examine the actual stock and analyze the financials. First off, we're looking at a P ratio that is very high, 43.9. Now it's getting lower than what it used to be, but it's still relatively high, and the price to free cash flow is also high. Interesting to notice that the outstanding shares are slightly elevated, but not to the point where that would be a massive X for me. It's almost a check mark or close to that. 4% is not a huge deal. Now the company has a ton of free cash flow compared to its total liabilities. We will examine that. And it has been increasing nicely, and still the company's revenue is at a level that it could keep increasing very nicely through the years. Net income is also increasing nicely, free cash flow nicely as well, and total equity growth pretty awesome too. Low debt, as we already talked about, and current ratio of 6.65 actually, which means that the company's current assets are 6 times more than the current liabilities, 6.6 times more, meaning that they have more in current assets, and current assets are like the 12-month short-term assets that the company has, the ones that can be liquidated in the next 12 months, and non-current current liabilities are the ones that need to be paid off in the next 12 months, and so they have 6.6 times more assets than liabilities when we're talking about the current ones, and great returns on equity here, and great margins of course, and dividend yield that is 0.1%, very low, but the payout ratio is super low as well, as you would expect with this kind of a low dividend. We can take a little bit of a look at what's happening with Nvidia's dividend. Back in 2012 it looks like they started that, and it's growing slightly, but it's still very low of course, as you'll see. Effectively at 0.09 right now. Okay, let's go back. And the next thing that we're going to examine, we're going to take a look at the financial statements, see what's happening. 9.7 billion in revenue to 26.9, and net income from 3 to 9.7 here. Great increase. And in terms of their balance sheet, they're also increasing their assets, 7.4 to 26.6. Pretty amazing growth here. Cash flow statement, you will see 3 billion to 9 billion, 9.7 has been their net income. That translates to 9.1 billion in operating cash flow. And the company is spending quite a lot as well, as you'll see here, in purchasing investments, which is interesting to see. The company seems to be buying a lot of securities and things of that sort. Interesting and probably nice, especially at this current time. And they're also spending a little bit in capital expenditures, but not much. This is the dividends that they're paying. This is nothing compared to their free cash flow. And they're making 8.1 billion in free cash flow, that is. And just getting a little bit of debt here, but still, I mean, they're very solvent. They don't have much trouble here in terms of debt. But 8.1 billion is what they did in free cash flow last year. Now we will take a look at the stock evaluation tool and see what kind of price it makes sense to pay for the company. Now you will see that this revenue growth has been pretty tremendous here. The averages have been near 33-35%. We're gonna go lower in this current period, especially 14, 16, and 18, and it may even be a little bit high. And net income margins have been pretty steady here. I'm gonna go, let's just go a little bit lower, 28, 30, and 32. Okay. For our free cash flow growth, we're gonna go in between 80, 90, and 100, which makes a ton of sense based on what they have been doing in the previous years. And an annual return of 13%, typical what I wanna be making. Let's hit calculate. And we are seeing that our current price at around 169 bucks right now is still very expensive. It's almost double as much as we'd like it to be. It's actually more than double than what we'd like it to be for our medium projections here. you would kind of expect that when you took a look at the price to free cash flow being that elevated. It looks like the company is expensive for what it is right now, and I'd like a much steeper decline for me to buy this one. I would probably want to be somewhere in between these levels here. 60-65 is probably the sweet spot. May not happen, but okay, there are other stocks that I can follow and buy, because we don't want to be overpaying. That's key when buying stocks and companies. And this one has been growing so much that you'll see here tremendous growth, and even at this current level, imagine it stopping here and having grown thus far. It's still pretty steep, and based on what the company has been doing, it's a little bit too much, and so I would likely avoid this one for now. And if you know, if there is no steep decline happening, I would just keep my money and utilize it in another company, just because I don't want to be overpaying. Because when you're overpaying, this kind of drops happen, and the problem is that it's difficult to go back. And the company has to do much better in order to reach these levels again. Because remember, this was 346, and currently we're sitting at 169, and we are still almost double the price we'd want to get it at, and it would be normal. And imagine going back to this price, how much more you need to be making as a company in order to get back to this level here. So people who bought here, it's problematic, because then the company will have to be doing much better, and it may take years in a normal market, or especially a market that is balanced out or bearish. This may not happen for a while, and so yeah, this is problematic for buying expensive. This is the big problem with buying things at an expensive price, and this is what I want to avoid and help people avoid with my videos here. Now, I'd like you to let me know what you think about Nvidia. So please, if you have your remarks to make, leave a comment below this video, and remember to like the video and subscribe if you enjoy this kind of content, just to help the channel grow a little bit. Just leave a like, and also remember that you can become a patron, and get access to this website just by visiting the link in the description box below this video. We'd love to have you here. We have quite a few people already, and this tool is getting better and better, hopefully. And yeah, so thank you for watching this one, and I hope you enjoyed. In the meantime, take a look at the video that I made earlier, and I'm discussing Snapchat, which is down 30% right now. Very interesting to watch this video. And thank you for watching this one again. I'll see you soon, guys. Bye bye.